Ladies and gentlemen, something remarkable has just happened in the Bitcoin market, and almost nobody is talking about it the right way. While most people are distracted by short-term price moves, headlines, and daily noise, the biggest players in this space have quietly done something extraordinary. Bitcoin whales, those who move markets without asking for permission, have completely reversed their strategy. And when whales change direction, history tells us one thing very clearly: the next phase is already being prepared. For months, fear dominated the crowd. Every dip felt like the end. Every correction was labeled a crash. Retail investors hesitated, sold in panic, or stayed frozen on the sidelines. But beneath the surface, something very different was happening. The same wallets that were distributing Bitcoin during strength have stopped selling. The same entities that were reducing exposure have shifted into accumulation mode. This is not speculation. This is behavior. And behavior always tells the truth before price does. What changed wasn't the headlines. What changed wasn't social media sentiment. What changed was conviction. Whales are no longer positioning for downside protection. They are positioning for survival in a world where hard assets matter again. Liquidity cycles are tightening. Trust in traditional systems is weakening, and long-term capital is moving before the crowd even realizes why. Think about this for a moment. Whales don't react to emotions. They react to data, structure, and inevitability. When they reverse an entire strategy, it means the risk is no longer where it used to be. The risk is no longer holding Bitcoin. The risk is being without it when the next wave begins. On-chain behavior shows longer holding periods. Large transfers are moving into cold storage, not exchanges. Selling pressure has dried up at levels where panic was once guaranteed. This isn't excitement. This is patience. This is preparation. And preparation always comes before expansion. Every major Bitcoin cycle has followed this same script. First, disbelief, then boredom, then quiet accumulation by those who understand what's coming. And finally, a move so fast and aggressive that most people are left asking the same painful question: why didn't I act when I had time? The market doesn't reward attention. It rewards positioning. Right now, the loudest voices are still arguing about the past, while the smartest money is focused on the future. Whales have stopped playing defense. They are playing offense again. This isn't a promise of instant gains. This isn't hype. This is a reminder. The biggest opportunities never arrive with noise. They arrive with silence, confusion, and doubt. And by the time clarity appears, the move is already underway. Ladies and gentlemen, when Bitcoin whales reverse their strategy, they are telling you something without saying a word. The question is not what they changed. The question is whether you are paying attention before the rest of the world is forced to. Bitcoin whales have clearly shifted from selling to accumulating, and this change carries far more weight than any headline or short-term price movement. For a long period, these large holders were gradually distributing their Bitcoin into strength, using market optimism as an opportunity to reduce exposure. This behavior is typical at the later stages of a rally, when experienced capital senses that risk is increasing. However, that phase has now ended. The selling has slowed, then stopped, and what has replaced it is steady, deliberate accumulation. This transition is not emotional or impulsive. It is calculated and deeply strategic. What makes this shift so significant is the scale and consistency of the activity. Whales do not buy in excitement or chase green candles. They accumulate during uncertainty, when confidence is low and participation is weak. The current environment fits that pattern perfectly. Price movements appear unconvincing, sentiment remains divided, and many participants are still recovering from previous volatility. Yet during this hesitation, large wallets are adding positions, often in a way that avoids drawing attention. This silent accumulation is designed to minimize impact while maximizing long-term advantage. Another critical aspect of this change is timing. Whales are not reacting to past losses or recent gains. They are positioning for what comes next. Their shift suggests that downside risk is now viewed as limited compared to the potential upside. When capital of this size accepts short-term uncertainty in exchange for long-term exposure, it reflects a strong belief that current levels will look cheap in hindsight. History reinforces the importance of this behavior. In every major Bitcoin cycle, sustained whale accumulation has preceded powerful market expansions. Those who recognized this phase early had time, patience, and clarity. Those who ignored it were later forced to react under pressure. This is why the move from selling to accumulation is not a minor adjustment. It is the foundation of the next market chapter. Large amounts of Bitcoin moving off exchanges into cold storage is one of the strongest signals of long-term confidence in the market. When whales transfer their holdings away from exchanges, they are deliberately reducing their ability to sell quickly. This is not something done lightly, because exchanges exist for liquidity and convenience. Choosing cold storage instead means these holders are not preparing to exit positions, but to hold through uncertainty and wait for a future valuation they believe better reflects Bitcoin's true value. This behavior also has a direct impact on market dynamics. Bitcoin held in cold storage is effectively removed from active supply. With fewer coins available on exchanges, selling pressure naturally decreases. Even modest increases in demand can then have an outsized effect on price because there is less liquid supply to absorb buying interest. Over time, this imbalance between supply and demand becomes more pronounced, setting the stage for sharp upward movements when momentum returns. What makes this shift especially important is the context in which it is happening. Market sentiment remains cautious, and many participants are still focused on short-term risks. Yet whales are choosing security and patience over immediacy. They are signaling that the current phase is not about quick trades, but about positioning for a much larger move. Historically, prolonged periods of exchange outflows have aligned with accumulation phases that later transitioned into aggressive market expansions. The weakening of selling pressure at key levels is a powerful sign that control of the market is shifting into stronger hands. In previous phases, every rally was met with aggressive sell-offs, quickly pushing price back down and reinforcing fear among smaller participants. That behavior reflected uncertainty and a lack of conviction, where even modest gains were treated as opportunities to exit. Now, that pattern is changing. Rallies are no longer being instantly sold into, and pullbacks are finding support more quickly than before. This indicates that the supply once eager to sell has largely been exhausted. Strong hands operate differently from short-term traders. They do not rush to take profits at the first sign of strength. Instead, they absorb volatility and allow the market to test levels repeatedly. The fact that Bitcoin can now revisit certain price zones without triggering massive sell waves shows that ownership has transitioned away from impatient holders. This creates a more stable foundation, even if price action still appears slow or uneven on the surface. Another important factor is how volatility itself has changed. Instead of sharp, emotional swings driven by panic, movements are becoming more controlled. This suggests that large buyers are stepping in quietly during dips, providing liquidity without pushing price aggressively upward. Their goal is not to create excitement, but to build positions efficiently. This kind of absorption often goes unnoticed because it lacks drama, yet it is one of the most reliable precursors to expansion. When selling pressure weakens, the market no longer needs extraordinary demand to move higher. It only needs consistency. Once sellers are no longer dominant, even average buying interest can shift the balance. Historically, this is the phase where markets appear frustrating and directionless, right before they surprise everyone. The absence of aggressive selling is not a sign of weakness. It is evidence that the groundwork is being laid for the next decisive move. Whales are not adjusting their strategies based on daily price fluctuations or online narratives. They are responding to deeper macroeconomic realities that shape the long-term environment. Tightening liquidity across global markets has changed how capital moves, making speculative behavior far more dangerous than it was during periods of easy money. In this kind of environment, assets with limited supply and strong network effects begin to stand out. Bitcoin fits that profile in a way few other assets do, which is why large holders are paying close attention now. At the same time, confidence in traditional financial systems is slowly eroding. Rising debt levels, persistent inflation concerns, and policy uncertainty have created an atmosphere where long-term preservation of value matters more than short-term yield. Whales understand that these conditions do not resolve quickly. They position years ahead, not weeks, and they are allocating accordingly. This shift explains why short-term volatility no longer scares them. They are not trading headlines or reacting to sentiment swings. They are aligning with structural trends that suggest demand for scarce, decentralized assets will grow over time. When capital of this size moves with patience in response to macro pressures, it signals preparation, not speculation. History shows that Bitcoin moves in cycles, and whale behavior has consistently been one of the most reliable indicators of where the market stands within those cycles. Before every major upward expansion, there has been a prolonged period where price feels stagnant, interest fades, and confidence is fractured. During these phases, disbelief dominates. Many participants assume the best days are over, attention shifts elsewhere, and volume dries up. Yet this is precisely when experienced capital becomes active. Whales thrive in environments of boredom and doubt. They understand that explosive moves are not born from excitement but from neglect. When the market is quiet and emotionally drained, assets can be accumulated without competition. This is why accumulation phases often feel uncomfortable and unrewarding in real time. Price action lacks direction, narratives feel weak, and patience is tested. Most people interpret this as a sign to disengage, but whales interpret it as opportunity. What follows this phase is always the same pattern. Once accumulation is largely complete and supply is locked away, even small shifts in demand can trigger disproportionate price reactions. Momentum builds faster than expected, catching late participants off guard. By the time optimism returns, the foundation has already been laid, and positioning becomes far more expensive. This repeating structure is not accidental. It is driven by human psychology. Fear pushes people out near lows. Boredom keeps them away during accumulation, and excitement pulls them back in at higher levels. Whales are aware of this cycle and use it to their advantage. When current market conditions mirror past accumulation periods, it is not coincidence. It is a signal that the same forces are quietly at work again, preparing the ground for the next powerful expansion. The idea that the greatest risk has shifted from holding Bitcoin to being unpositioned is difficult for many to accept, especially after periods of sharp volatility. Fear has a way of anchoring people to past pain, making them believe that avoiding exposure is the safest choice. However, markets do not reward comfort, they reward foresight. When the structural risk of an asset decreases while its long-term potential remains intact, the danger lies not in participation, but in absence. Bitcoin has already survived multiple cycles of extreme stress, regulatory pressure, and public skepticism. Each time, it emerged stronger, more decentralized, and more widely understood. With every cycle, the probability of total failure decreases, while the probability of adoption increases. Whales recognize this trajectory. To them, Bitcoin is no longer an experimental asset, but an established monetary network still early in its global adoption curve. The volatility that scares smaller participants is viewed as noise within a much larger trend. Being unpositioned during early phases of a major move carries a hidden cost. It forces reactive decision-making. When price begins to rise aggressively, those without exposure are compelled to chase, entering at higher levels driven by urgency rather than strategy. This is where mistakes compound. Instead of accumulating calmly during uncertainty, capital is deployed under emotional pressure, often at precisely the wrong time. Another layer of risk comes from opportunity cost. Capital sitting idle during accumulation phases does not remain neutral. It loses purchasing power over time, especially in environments where inflation and currency debasement persist. Whales factor this into their calculations. They are not just protecting against downside, they are protecting against erosion. Holding a scarce, deflationary asset becomes a hedge against systemic dilution elsewhere. There is also the risk of narrative shock. Markets tend to move before explanations catch up. When a shift becomes obvious, it is usually because price has already adjusted. By the time mainstream narratives turn positive, the easy positioning is gone. Whales aim to be early enough that conviction replaces fear, not the other way around. This does not mean ignoring risk entirely. It means understanding where risk truly lies. For whales, the greater threat is waking up to a market that is repriced without them. They accept short-term discomfort to avoid long-term regret. In doing so, they redefine what risk means at this stage of the cycle. It is no longer about surviving another dip. It is about ensuring participation in what comes after.